Well, if the Reserve Bank was looking for guidance from today's retail sales number, look, to be honest, there wasn't much on offer. The sales rose 0.2% in February, which is pretty modest. It followed a 1.8% jump in January, which seems to be something of an aberration. But look, there's evidence also that spending is relatively strong in department stores, cafes and restaurants, and in clothing and footwear, all discretionary spending areas. So let's bring in here David Rumbens from Deloitte Access Economics to try and work this out. David, look, it's really 10 interest rate rises. Have really the squeeze been put on households or not? Can you see it from these numbers?
Look, I think you'd have to say that it has. Now, it's hard to tell from month-to-month numbers, and you're correct to say that this is a bit of a neutral number, 0.2% growth. That's in nominal terms, so it's not strong. But if you put that in the context of where we've been the last few months, you compare retail spending in February with back in September, and you've got no change over that period. So over a 5-month period, retail sales haven't grown, and that's in nominal terms or money of the day. If you take into account inflation, that's about a 2.5% fall in real terms. So if you look over that longer period, I think you can say that's it's a pretty dire retail environment over the past few months.
Because what you're saying is because of inflation raising the price of goods, the people might be spending the same, but effectively they're buying less because, that's really the nature of the way in which things go when prices go up.
Well, that's exactly right. I mean, consumers are getting less for their dollars. So with price growth of about 2.5% in that time, it means that's eroded the value of spending. Now, for retailers, it also means that revenue growth doesn't all go to the bottom line. That the bottom line moves more with the volume of sales. So retailers are some retailers at least are probably seeing a decline in their profits over this period. So it's kind of what you'd expect in an environment where we have had so many rises in interest rates in a row. It is starting to have an effect, and in fact, it's more than starting to. It's pretty conclusive evidence that it is having an effect on consumer spending over the past few months.
Okay, so this was one of the indicators that the Reserve Bank indicated that it would be watching. Is this enough of an indicator to start to slow the pace of interest rate rises in Australia?
Look, it's probably one of those annoying ones that you could interpret either way. It wasn't really, really weak, and nor was it a rebound. So if it certainly, in my view, confirms the picture of a retail environment where there's no growth. In fact, it's going backwards in real terms, and that's a sign that it's really probably is time for the Reserve Bank to pause rates. That said, if the Reserve Bank was of an inclination to keep rising because of other indicators, because of the resilience in jobs, because looking in the rearview mirror, we still have strong annual inflation numbers. If they were of that mind, then this number wouldn't necessarily dissuade them from that.
Okay, because for some people it was thought that maybe these interest rate rises, the cumulative effect of those would eventually be like a brick wall in front of consumers at some stage this year. And at some point that these retail sales would really almost be the number one barometer of the hurt that those rate rises were seeing. This is slowing, but it's not certainly the car crash that many people might have expected.
Yeah, it's not in 1 month, but if we look at it over a period of time, it doesn't then look that pretty. So if we look at the December quarter, retail sales went backwards in real terms in the December quarter. Now, we've had that little rebound in January that you mentioned, a bit of an anomaly, and then this small growth in February. Unless we get something very strong in March, we're going to have the same result in the March quarter, retail sales going backwards in real terms. So we'll have had 6 months. If we did that for economic growth, we'd call it a recession. So, we could almost call it a retail recession at this point in time. It is certainly having an effect on consumer spending. Maybe it's not a brick wall or a cliff, but it is certainly accumulating.
So then take me to the overall economic output of Australia. If retail sales in real terms are slowing and going backwards, what does it say for Australia's economic growth, given the fact it was expected to slow during the course of this calendar year as well?
Yeah, I think it's consistent with economic growth slowing. It's those sectors that are more credit sensitive, are being harder hit. So we're seeing it in residential housing construction. That's gone down. New building commencements have gone down. We're starting to see it, well, we are seeing it in retail. We're seeing it to some extent in broader consumer spending. So we should say that spending on services is holding up better than spending on goods. But broader consumer spending is moderating as well. Other parts are perhaps not doing so badly. Government spending is solid. We've got exports revenue is good. We've got a support from population growth coming through as well. So there are some tailwinds, but it's certainly consistent with a view that economic growth in 2023 will be a lot slower than we saw in 2022.
David Rumbens,
yeah.
I'll jump in there if that's okay. David Rumbens from Deloitte Access Economics. Great to have you on the program, and many thanks for your time today.
Thanks, Ross.